Hey everyone, and welcome to This Explainer. Today we are going to unpack a really fascinating financial mystery. It's a story that completely defies traditional investing logic, and it centers around Madrigal Pharmaceuticals, a biotech company that presents us with what I like to call the $11 billion paradox. Now, if you've ever looked at a stock chart and thought, wait a minute, the numbers here make absolutely zero sense, well, you are going to love this one. We're going to dig right into the raw data, look at the evidence, and decode exactly how the market is valuing this incredibly unique company.
So let's just jump right into the central paradox we're solving today. How does a stock consistently lose hundreds of millions of dollars, yet somehow manage to reward its long-term investors with a staggering 282% growth over 5 years? I mean, in almost any other industry, that combination of numbers would be a massive red flag signaling an impending bankruptcy. But here, it actually signals a highly calculated high-stakes game. Let's start uncovering the clues.
Part 1. The $11 billion paradox.
Okay, let's dive into this. Madrigal's current market capitalization sits at $11.918 billion. To put that into perspective, an almost $12 billion valuation means the market treats this company as a massive, heavy-hitting player in the pharmaceutical space. Investors have literally parked nearly $12 billion of wealth into this enterprise. And when you see a massive number like that, you naturally assume the company is churning out steady, reliable profits to justify that kind of premium, right? Well, hold that thought.
Now, what's really interesting here is the intense visual whiplash. Right next to that nearly $12 billion valuation, we have Madrigal's trailing 12-month net income sitting at a deeply negative $288.2 million. They aren't just missing profitability by a little bit, they are burning through over $250 million a year. If you're a traditional value investor who looks for steady earnings, seeing this kind of massive deficit is enough to make you close your laptop and walk away for sure. But the market isn't stupid. There's a very specific reason for this massive discrepancy.
Moving on to Part 2. Massive returns, negative profits. Look at the stark contrast between these two realities. On the left side, we have the bull case. If you had bought and held this stock 5 years ago, you'd be sitting on a phenomenal 282.56% return. Your investment would have nearly quadrupled. But on the right side, the bear case brings up a truly terrifying metric, a return on invested capital of negative 86.58%. In plain English, for every dollar the company recently invested into its business operations, they lost a massive chunk of it. It just looks like a financial black hole. So how on earth are those early investors making so much money?
The answer to that lies in the extreme volatility of their historical returns. In 2017, the stock just exploded with a 516% return. In 2022, it happened all over again with a 242.52% jump. Currently, in 2026, it's sitting at a negative 11.27% year-to-date. This is absolutely not a slow, steady climb. This is the very definition of explosive upside. Historically, the market just hasn't cared about the quiet money-losing years because when Madrigal hits a major milestone, they reward patient investors with parabolic rocket ship growth.
Now, real quick, before we move on, let's just contextualize the jargon for a second. Return on invested capital, or ROIC, measures how efficiently a company uses its capital to generate profits. Normally, a negative 86% ROIC means you should run away as fast as you can. It usually means the core business model is deeply broken. But in the biotech and pharmaceutical sector, investors are practically sprinting toward it. Why? Because in this specific industry, a massively negative ROIC doesn't mean you're bad at selling things. It usually just means you're pouring every available dollar into heavy research and development before you even have a product to sell. It's literally the cost of entry.
Which brings us to Part 3. The sudden revenue explosion.
And this brilliantly illustrates the turning point for Madrigal. Look at the 3-year and 5-year compound annual growth rates. Past revenue is a flat, absolute 0%. For years, this company generated nothing. Zip, zero. They are purely a research and development entity, just burning cash to find a scientific breakthrough. But now, jump to the present trailing 12-month revenue CAGR. It has violently spiked to 432.05%. The research phase ended and the explosive commercialization phase began. The switch was quite literally flipped.
So the crucial point is exactly what happened when that switch flipped. They didn't just start making a little bit of money on the side. Their trailing 12-month revenue suddenly reached $958.4 million. That is nearly $1 billion in revenue, seemingly overnight. But the absolute most important number in this entire analysis is that second figure, a gross profit margin of 95.77%. That is astronomical. It means that for every dollar of product they sell, it only costs them about 4 cents to actually make that product. That is software-level profitability on a physical pharmaceutical product. It's wild.
Part 4. Surviving the cash burn.
Now, the data shows us they had a negative free cash flow of minus $193.8 million. You might be wondering, how does a company burn nearly $200 million in cash without going bankrupt before their product even hits the market? Well, the answer is their liquidity. Notice the current ratio sitting at a very comfortable 4.01 and the quick ratio at 3.77. In finance terms, a current ratio over 1 is healthy. A ratio of 4? That means Madrigal maintained massive short-term liquidity. They held 4 times the amount of cash and easily liquidated assets needed to pay off their immediate liabilities. They essentially built a massive financial fortress to safely weather the cash burn.
Furthermore, they managed to survive that burn phase without drowning themselves in toxic debt. Their debt-to-equity ratio is just 0.56. They relied heavily on equity rather than taking on massive, high-interest loans that could have easily crushed them before that 432% revenue growth ever materialized. This low debt ratio gave management the necessary runway to just let the science play out. It was a perfectly executed survival strategy.
And finally, Part 5, the future growth bet.
Let's pull all of these structural clues together and see how this builds into the classic biotech success story. The paradox is actually totally solved when you look at the steps. First, they survived an intense cash burn period through highly disciplined liquidity management, right? That's our 4.01 current ratio. Second, they successfully transitioned from years of 0% revenue directly into explosive 432% revenue growth. Third, that growth wasn't an illusion. It generated $958 million in top-line revenue with massive 95% gross margins. So why the $11 billion valuation when the net income is still negative $288 million? Because the market knows that those massive early R&D losses are just the necessary admission ticket. With 95% gross margins, once the initial fixed costs and rollout expenses are covered, almost every new dollar of revenue is going to fall straight to the bottom line. Investors are simply pricing in the inevitable future cash printing machine.
Which brings us to our final thought. The Madrigal Pharmaceuticals paradox teaches us a profound lesson about market valuations. You really have to ask yourself, are you investing in what a company earns today or what it could become tomorrow? If you only looked at today's net income, you'd see a failing business losing hundreds of millions of dollars. But if you look at the strong liquidity, that sudden 432% revenue spike, and those staggering 95% gross margins, you see exactly what the market sees, a potential giant just waking up. It takes a completely different mindset to understand a biotech valuation, one that completely ignores the rearview mirror and focuses entirely on the horizon. Thank you so much for joining me for this explainer, and always keep questioning the numbers you see.